Welcome to The Explainer. Today we're zooming in on Italy's largest banking group, Intesa Sanpaolo, which honestly finds itself standing at an absolutely fascinating historical crossroads. On one hand, the bank is generating just incredible, record-breaking profits. But on the other hand, it literally just launched a massive, potentially industry-altering takeover. It's really a classic corporate finance story. We're watching them balance a golden status quo against a highly ambitious transformational leap.
Okay, let's dive right into this. Here is our roadmap for today's explainer. We'll start by looking at Intesa as a cash-generating machine, then break down the massive MPS takeover, weigh the strategic rewards versus the risks, check in on the analyst views, and finally, deliver the investment verdict.
Part 1. A cash-generating machine. Record financial performance. So, Intesa Sanpaolo just delivered its absolute best first half in history for 2026. We are talking about a staggering annualized return on equity, which is a crucial measure of profitability, of approximately 21.5%. That single figure alone puts them right among Europe's absolute best-performing banks. And they aren't just making money, they're hyper-efficient while doing it. Their cost-to-income ratio is sitting at an industry-leading 35.9%. Seriously, they are running a remarkably tight ship.
And you know that incredible efficiency translates directly into shareholder pockets. Under their 2026 to 2029 business plan, Intesa is executing this massive 95% payout ratio strategy. That's 75% returned via cash dividends and 20% via share buybacks, leaving just 5% retained. To put that into perspective, they recently delivered a $6.5 billion total cash dividend for 2025, and then they went ahead and launched a $2.3 billion buyback in July 2026. So what does this actually mean for you as an investor? Well, based on those 2025 results, you're looking at a highly attractive 7.5% dividend yield.
Moving to Part 2, the massive MPS takeover, a $30.6 billion catalyst.
Let's completely unpack the mechanics of this voluntary public tender and exchange offer. This deal is huge, valuing MPS at a whopping 30.6 billion euros. The exchange ratio is highly specific, so pay attention here. For every 10 MPS shares, you get 16 newly issued Intesa shares, plus a kicker of €1 in cash. That implies a price of 10.091 euros per MPS share, which actually gives MPS shareholders a really nice premium of 12.5% to 18.7% over recent trading levels. It's a bold, highly premium offer for sure.
So, why do it? Well, the strategic rewards are honestly incredible. First up is just sheer scale. The combined entity would have over 27 million clients and be targeting 2 trillion euros in customer financial assets by 2029. Then, you have to look at the synergies. Management expects 2.9 billion per year in run rate synergies by 2029, mostly coming through wealth management. Ultimately, this means about an 8% bump for both earnings per share and dividends per share. That's a direct boost to bottom-line profitability and cash payouts. Because of this specific deal, total capital distribution from 2025 to 2029 is projected to jump from 50 billion euros all the way up to approximately 61 billion euros. And that includes an extraordinary $2.7 billion cash distribution just for 2026 and 2027 alone.
But here is the multi-billion euro question we really need to ask. Can Intesa actually execute this massive integration while maintaining their industry-leading efficiency? Integration complexity is a massive hurdle. They are currently estimating 2.1 billion euros in integration charges. Now, to be fair, management does have a proven track record here. They successfully integrated the Venetian banks and UBI Banca in the past. And get this, they've remarkably committed to absolutely zero social costs, meaning any exits will be totally voluntary and actually matched by hiring young talent. But still, integrating MPS and Mediobanca together, that is no small feat.
Which brings us to Part 3, strategic rewards versus risks, the balance scale.
Cue the dramatic twist. Out of nowhere, Banco BPM proposes a rival bid, a merger of equals with MPS. If this is successful, it would create Italy's second-largest banking group with over $50 billion in market cap. This sudden competitive pressure sent shockwaves straight through the market. Intesa shares actually fell 2.1% on the news, while MPS shares surged roughly 12% right up to that €10 mark. Make no mistake, the battle for MPS is fierce.
Now, to prevent a monopoly and keep regulators happy, Intesa is being highly proactive. They've already set up a strategic agreement with Unipol Assicurazioni to sell off roughly 635 MPS branches, along with the actual MPS brand itself. This mitigation strategy is estimated to bring in a very impressive $3.0 to $3.5 billion, which, let's be honest, certainly helps cushion those massive $2.1 billion integration costs we just talked about.
Section 4. Analyst Views. Bull versus bear.
Let's see how Wall Street is digesting all of this. Overall, the consensus remains overwhelmingly positive. Jefferies is at a buy with a €720 target. Goldman Sachs reiterated their buy, bumping their target up to €710. Both JP Morgan and RBC Capital sit at a buy rating with a €700 target. And according to S&P Global data, the overall consensus price target is €689, which represents roughly 8% to 13% upside. However, Morgan Stanley actually downgraded the stock to equal weight with a €660 target.
Let's actually zoom in on that bear case directly from Morgan Stanley analyst Noemi Peruch. She notes that, sure, while Intesa isn't trading on demanding multiples, they worry about a, quote, limited growth profile and the lack of catalysts ahead. Morgan Stanley's projections basically paint a much more cautious picture of organic growth, giving us a bear case price target of €5.10 stacked against a bull case of €7.60. It really highlights a very real anxiety on Wall Street over the integration risks versus core business growth.
Finally, Section 5, the final investment verdict. So the crucial point is, what does this all mean for us? We can basically distill this into two perfectly balanced arguments. The bull case points directly to that incredible 95% payout strategy, a transformative €2.9 billion in deal synergies, and an 8% boost to earnings per share. It's about the creation of a true, undeniable European powerhouse. But the bear case? You can't just ignore it. There are daunting $2.1 billion integration charges, serious competitive threats from Banco BPM, and lingering concerns that underneath the shiny new merger, organic growth is simply too limited.
To wrap this all up, Intesa Sanpaolo is, without a doubt, a high-quality, cash-generating franchise providing exceptional shareholder returns. However, the stock is currently trading at a pivotal, high-stakes moment in its history. Realizing the upside relies entirely on management's ability to seamlessly deliver that €2.9 billion synergy target without dropping the ball. Ultimately, what you should take away from this is that forming an investment thesis right now really hinges on your own personal risk tolerance regarding integration complexity and execution.
We're going to leave you with this final, thought-provoking question on the ultimate banking safety metric. Will Intesa's CET1 ratio, their core financial safety net against risk, actually stay above that 14% mark by 2029 as they expect? If management can successfully navigate this massive integration and the fierce competition, all while keeping their capital position this rock solid, they might literally just pull off the deal of the decade. But as we know in banking, execution is absolutely everything. Thank you so much for joining us for this explainer, and we will see you next time.